Time now for business, and we've got a special treat today. Giles Beckford, who's not normally allowed out at this time of the day, is joining us for business. Hi, Giles.
I'm not sure it's a treat, Lisa, but thank you for saying so.
Yeah, anything could happen from this point onwards. You have a tale of two companies with earnings and forecasts. Very Charles Dickens of
Contrasting fortunes, very much
Yeah.
so. One is Kiwi Property Group, which is one of the biggest listed property companies in this country. Specialises in office buildings, commercial developments, shopping malls, and like a lot of the property sector in recent years, it's slowly reorienting its activities towards Auckland, or as it calls it, the Golden Triangle, which is Auckland, Hamilton, Tauranga. Its profit, $138 million, pretty good, from last year's $120 million, largely because of increases in the value of its properties, and they show up on the bottom line. But its income, although down slightly, is holding up. It's changing its mix. It's divested a couple of properties, so that hurt the income a little bit. It doesn't have the assets to earn from. I contrast that with Steel and Tube. Now, Steel and Tube is one of the old dinosaurs of the stock exchange. It's been around forever and a day, but it's been a symbol of the problems of the construction sector. And it was one of the first to wave the red flag about its earnings a few years ago. You remember it got caught up in the steel mesh controversy.
Yep.
It was on the tail end of a lot of money-losing projects, because as is the norm within the construction sector, all the losses get shunted down the pipeline, and everybody was trying to make Steel and Tube wear the cost, and they did. And that came through a couple of years ago. They went through restructuring and the like. Today they've come out and said, yeah, it's getting pretty tough out there in the construction sector. We're finding our margins are squeezed. We find that perhaps we didn't have quite the right mix of products. We've had to revise some of our earnings from previous years because of the way the accounting rules comply and they apply to them. So they've cut their earnings forecast probably by about a quarter. They have been spanked by 13%. Their share prices just plunged 13% today. I think it's a case of once bitten, twice shy from investors. They're going to have to do a lot to get back the confidence of punters to say it's a company worth investing in and sticking with. Although they are still adamant that they're in pretty good shape. They meet all their banking rules. You know, it's a rough patch that they're going through. I think it's another little sign that the construction sector is not the happy place, and that there are people still feeling a lot of pain, Steel and Tube being one of them.
Interesting. Okay, well, in the service sector, growth in the service sector continuing to slow down. What's that all about?
Well, every month, two indicators come out. One is about manufacturing, one is about the service sector. And you might go, ho-hum, service sector. It's 2/3 of our economy, and that needs to be borne in mind. It's shops, it's financial services, it's consumer spending, right? It's tourism, right? All flows through. It's down now to one of its slowest levels in several years. When you crunch the manufacturing numbers, which were slightly up but a bit mixed on Friday, with the service numbers that we've got today, and it's pointing to a slowing economy, an economy which the BNZ economists who look after the numbers here, they suggest that we might see our annual growth fall to 2% or below 2% over the coming year. Why is that important? Well, first of all, it's going to be a good deal more pessimistic than any numbers that you see in the budget next week. Right? It's what a lot of people predicate their decisions on. They're basing it on what will economic growth be. It suggests that it's going to be tougher times for us. And, we shouldn't get perhaps too carried away with big expectations of spending. The government's coffers might well take a bit of feel the squeeze because of a slower economy.
So is this the early signs of people circling the wagon with their spending because they see a bad moon on the
rise?
Well,
consumers, you think about your own habits, right? You think twice about whether you want to buy that big TV, right? Whether you're going to take your holidays in Mexico this year or whether you might just go to Paihia.
Oh, you make it sound so good, Giles.
So good. So those are the sorts of things. Yes, people become far more cautious. And from that point of view, it's another flag. It's a harbinger that our economy is going through a cycle. We're on the downside of that cycle. It's just going to make it a little bit harder for the decisions that the government has to make. It might have to make some brave calls.
Well, we wait and we watch. Markets today, what's been going on there?
Well, having given you a dose of gloom,
Yes.
let me give you a little
Have
bit
you got
of,
a record for us
let
today,
me give
Giles?
you a little bit of a... Of course I've got a record. That's why I'm in Auckland. Right, the share market top 50 index up 0.5%, 53 points, 10,234. Sniff the breeze. I'm not sure it will stay there, but you never know. One tweet out of the White House could send it heading south. For the currency, 65.4 US cents and 94.4 Australian. If you're going overseas, not bad rates to buy.
Are we leaving pence off the agenda today? Do we know?
For you, about 51.2 British pence.
Brilliant. Thanks, Giles. Giles Beckford with our business news today.